In the long history of the United States Marine Corps, few officers have earned as many medals as Major General Smedley Butler. But in 1935, near the end of his life, this highly decorated general published a short booklet titled "War is a Racket." He argued that international conflict operates as a closed financial loop. A tiny, insulated elite calculate profit margins safely away from the battlefield, while the vast majority of citizens pay the true costs in higher taxes and lost lives. Butler knew the mechanics firsthand. Over a 34-year career, he led military interventions across the Philippines, China, Central America, and France, directly securing foreign resources for American banks and corporations. His conclusion laid bare the reality of defense spending. The military economy operates exactly as designed, a machine built to transfer public wealth into private hands. Fast forward 9 decades to the years 2025 and 2026. The United States is locked into an active military escalation in the Middle East, conducting massive operations across Iran and Lebanon that result in widespread regional devastation. This chart illustrates the divergence. As billions of dollars drain from the defense budget and global energy prices spike, everyday economic indicators trend downward. Yet, simultaneously, the valuations of specific defense technology and drone companies rocket upward. The investors cashing in on this specific market surge are not traditional defense contractors. They are the direct family members, campaign financiers, and close allies of the sitting President of the United States. The dynamic has evolved. Instead of corporations spending millions to lobby the government for contracts, members of the executive branch now hold direct equity in the companies receiving those contracts. The vehicle for this strategy begins with an investment fund called 1789 Capital. Established to promote what its founders call patriotic capitalism, the fund specifically targets companies focused on domestic industry and military technology, explicitly rejecting climate and social initiatives. In November 2024, immediately following the presidential election, Donald Trump Jr. joined 1789 Capital as a full partner. Following his arrival, the fund's assets swelled from $200 million to surpass $2 billion. That capital was aggressively deployed into 3 defense startups: Anduril Industries for AI drones, Firehawk Aerospace for rocket fuel, and Vulcan Elements for rare earth magnets. The network stretches further. In February 2026, Eric Trump entered as a strategic investor in a $1.5 billion merger involving the Israeli drone manufacturer Xtend, aiming to list the company on the US stock market. This illustrates the initial positioning phase. Insiders legally acquire substantial equity in a niche defense sector right before the federal government alters the market conditions for that exact sector. Following the 2024 election, Donald Trump Jr. took an active role in personally evaluating candidates for top Pentagon positions. By his own admission, he focused on finding officials willing to pivot military spending from traditional fighter jets toward large swarms of inexpensive drones. By late 2025, the administration executed a broad policy shift, invoking national security to ban the procurement of all foreign-made drones and their internal components. Look at how the capital is forced to move. With overseas competitors cleared from the board, the massive demand of the U.S. military apparatus is funneled down a single path, directly toward the domestic manufacturers the insiders had just heavily invested in. The investors did not accurately predict the growth of the domestic drone market. They utilized executive policy to remove the competition and legally guarantee the market's expansion. Once the board was set, the contracts followed. 4 different companies held within the 1789 Capital portfolio secured federal defense contracts exceeding $735 million in total. A component manufacturer called Unusual Machines received its largest military order to date for 3,500 drone motors. Donald Trump Jr. directly owns over 330,000 shares of the company, a stake valued around $4 million. But the most striking transfer of federal funds involved Vulcan Elements, a startup operating with fewer than 30 employees. This scale visualizes the math. The Pentagon awarded Vulcan a $620 million loan, dwarfing the company's $200 million valuation. Simultaneously, the Department of Commerce approved an additional $50 million in federal incentives for an equity stake in the startup. The loop is now closed. Executive policy shapes the market, and massive allocations of taxpayer money flow directly to companies owned in part by the policymakers' inner circle. By January 2026, the scale of these transactions triggered formal pushback. Senators Elizabeth Warren, Richard Blumenthal, and Andy Kim sent a joint letter demanding transparency from the Secretary of Defense. They pointed directly to the financial anomalies, citing blatant conflicts of interest regarding the president's family, and questioning the extreme artificial overvaluation of companies like Vulcan. Their letter highlighted a critical vulnerability. Using the defense budget as a private wealth generator actively compromises the country's national security. We can observe the complete mechanism in 3 steps. First, acquire strategic assets in defense technology. Second, implement executive bans on foreign competitors. Finally, direct hundreds of millions in federal contracts to the newly isolated assets. The boundary separating the state from private enterprise has dissolved. The individuals designing military strategy and the investors profiting from it are now occupying the exact same rooms. When Major General Smedley Butler looked back at his career in 1935, he realized that the theater of war was ultimately managed by accountants and executives, safely separated from the violence. Fast forward 9 decades later, the system operates exactly as he described. Only now, the mechanics of war profiteering are no longer a hidden byproduct of the system. Today, they are the standard operating procedure. For nearly a century, war profiteering was a slow, bureaucratic process. Giant defense contractors spent decades lobbying in Washington, maneuvering through years of committee hearings just to secure a single weapons contract. That cycle was bypassed on February 28, 2026, when the United States and Israel launched a massive, highly classified drone campaign against Iran. In this conflict, the standard delay between the declaration of war and the generation of profit disappeared. Private accounts belonging to the president's family and cabinet members saw massive capital inflows weeks before the first drone was even launched. The administration effectively converted the Oval Office into a venture capital firm, using highly classified military intelligence to build and scale a weaponized investment portfolio. 11 days before the strike on Iran, Eric Trump moved his capital into Xtend AI Robotics, an Israeli firm specializing in the exact tactical drones that were used in the opening hours of the invasion. Donald Trump Jr. followed a similar path, joining his brother to back Bowers, a newly formed drone manufacturer based in Florida. To obscure the direct link, they funneled money through venture capital vehicles, including American Ventures and Unusual Machines, to finance Bowers. As conflict escalated, Bowers sold anti-drone systems to vulnerable Gulf states. This creates a coercive marketplace where foreign allies facing intense diplomatic pressure from Washington find themselves purchasing military defense directly from the president's sons. The scale of this profiteering expanded through the administration's inner circle. Billionaire Peter Thiel and Palmer Luckey pivoted their focus toward AI-driven defense systems through their firm Anduril Industries. 2 weeks into the Iran war, the Pentagon awarded Anduril a single $20 billion contract spanning 10 years. This chart shows the immediate impact. In less than a year, Anduril's valuation doubled to $60 billion. Donald Trump Jr. directly benefits through his venture fund, 1789 Capital, holding a significant stake. A single military escalation triggered a government contract that mathematically multiplied the net worth of the president's son. This financial alignment even reached the predictive crypto markets. Donald Trump Jr. sits on the advisory board as Market, a platform where users bet on the timing of military strikes. This timeline shows a sudden surge in yes bets on a US strike against Iran, appearing on the blockchain just hours before the mission was declassified. These winning bets, worth $1.2 million, originated from newly funded anonymous wallets. The foresight extended to the Secretary of War, Pete Hegseth. Internal alerts at BlackRock reveal that Hegseth's financial advisor attempted to move millions into defense ETFs just weeks before the invasion, benefiting from his own military orders. When the Secretary of War and anonymous crypto traders both place massive bets with perfect timing, it suggests the timeline of a classified war was being treated as insider information. This map tracks the 2026 conflict, from the physical drone hardware and AI software to the interception contracts and betting markets. Every path routes back to the private accounts of the administration. The standard ethical safeguards have been discarded, replaced by a second-term strategy that treats military power as a tool for personal wealth. The U.S. military command structure now functions as the security detail for a global investment portfolio. When airstrikes are indistinguishable from a private equity strategy, the motives behind American military intervention become impossible to separate from a personal balance sheet. If the very concept of a global leader acting on principle dissolves, the credibility required to remain a superpower may be the final asset this administration liquidates.